What's up, you guys? It's Crypto Graham here. Just a prank. Don't unsubscribe, don't dislike, don't angry comments. Today, I want to talk about the 7 best tax write-offs in real estate that you might not know about. So let's start here at the very beginning. Owning real estate is a lot more than just having a property that spits out monthly profits. Instead, the tax advantages of real estate make it unique among almost every single other investment out there. And when it comes to real estate, the return that you get every single month can be calculated in so many other ways just besides the rent money you receive. Sometimes with some of the tax write-offs, you can make money every single month, but on paper, you're at a loss, and therefore it completely cancels out the tax obligation of owning that property. So as requested from you guys a lot, here are my top 7 real estate tax advantages that make it a phenomenal investment. So the first one is the mortgage interest write-off, and this is one of my favorite write-offs in real estate. Now, if you don't know what this is, let me explain. Let's say you have a $500,000 mortgage on a property and you pay 4% interest per year. That means that you're paying $20,000 per year in interest. You can write that interest that you pay on your loan against either your own taxable income on a primary residence or against any rental income you receive. Now, if you apply it to a principal residence, it looks like right now it's going to be capped at the first $750,000 of a mortgage, or if you have a rental property, it makes no difference if you have a $200,000 mortgage or a $5 million mortgage, because that's an expense against your rental income no matter what. So in our $500,000 mortgage example, let's say on that property that you're grossing $50,000 per year in rent. You would then subtract the $20,000 that you paid off in interest, and your new gross amount on that property would now be $30,000. And this effectively lowers your mortgage interest rate by the amount that you would usually be taxed at. So let's just say in a primary residence, you're paying $20,000 a year in mortgage interest, and you're in a 25% tax bracket. That means that you can deduct that $20,000 off of whatever your income is, and essentially you would save about $5,000 in taxes if you're in a 25% tax bracket. This means that effectively what you're really paying instead of 4% is really more like 3% per year because it's a write-off. Now, this is also a huge advantage of owning real estate and then leveraging your money on top of that. And like I said, even though this looks like it's going to be capped at a $750,000 mortgage on a primary residence, when it comes to an investment property, it has no difference whatsoever. You can have as big of a mortgage as you want, that's still an expense against your rental income. This makes it even more appealing to own rental property because you could deduct pretty much everything against that income. This is also one of the reasons why you don't want to just buy a property in cash and keep it and not have a loan against it. Having a loan against your property and leveraging your money in real estate is one of the unique reasons why real estate is such a good investment long term. Leveraging your money in real estate is a lot different than doing it on margin in stocks or leveraging your money elsewhere. In real estate, if you can lock yourself into a very long-term loan at a low interest rate, it almost always makes sense to leverage your money in real estate. And when it comes to this, I did a video earlier in the year comparing stocks to real estate. And pretty much they were on par if you don't leverage your money in real estate, and then real estate came with all the headache of like being a landlord and all these other things. So if you're not leveraging your money in real estate, you're almost better off just going with an index fund that would pretty much get you the same return minus all the headaches of being a landlord. But if you leverage your money, this is where you can get some significantly higher returns than almost any other investment, maybe besides Bitcoin, which I didn't buy in at a 10,000. So the second write-off you have are property taxes. Now this is something you can write off against your personal income or your rental income. If you're writing this off your personal income, right now it looks like you can deduct up to $10,000 of property tax per year. And as an investment property, you can still deduct 100% of your property taxes against your rental income, so that hasn't changed at all. So on our first example of the $500,000 mortgage where you're paying $20,000 in interest, of that, your property taxes might be another $5,000 per year. So you would then deduct the $20,000 in mortgage interest and the $5,000 that you pay in property taxes against the rental income that you receive. This will lower the amount of taxes that you pay on that rental income. And on a primary residence, deducting $10,000 a year in property tax could end up saving you several $1,000s a year in a tax write-off. This just effectively lowers the property tax rate that you would overall pay. The third one, and this is a fun one, is depreciation. This is something where you can end up with money in your pocket every single month, but on paper, all of a sudden you're showing a loss, and you pretty much will pay no taxes if you depreciate certain things at certain times in the right way. So when it comes to investment property, you're able to depreciate the asset over a certain amount of time. Generally, it's 27.5 years, but certain things are able to be depreciated at higher rates than others. For instance, you might be able to deduct the cost of a brand new kitchen over the course of 10 years instead of the 27.5 years. This means if you spent $10,000 on a kitchen and you depreciated it over 10 years, that means that you can depreciate the cost of that by $1,000 per year against your rental income. And this tactic is known as cost segregation analysis. Think of it this way, a car depreciates in value over time. And therefore, when you have a car like this, sometimes you're able to depreciate the value if you're using it as an investment or for business. Same with real estate. A kitchen is not going to last 200 years. The house, chances are, is not going to last 150 years. Therefore, we can assume that the property value is going to depreciate over time. Even though the land value might go up, even though the cost of materials might go up, even though the house might be worth way more 10 or 20 years from now, the thing is the actual structure of the house isn't gonna last forever. The kitchen is not gonna last forever. So we assume for tax purposes that all of these have a lifespan to them. So we can assume maybe that these hardwood floors might have a lifespan of 20 years. Therefore, if you spend $10,000 doing all new hardwood floors with a 20-year lifespan, we can depreciate that, let's just say $500 per year against your rental income, because at some point this is going to be a new expense in terms of maintaining the property. Or sometimes people just deduct the entire cost of the property itself minus land value over the course of 27.5 years. So if you had a $275,000 house, for example, over 27.5 years, you can deduct $10,000 per year from your rental income. This is just amazing for lowering your tax liability, especially when it comes to rental income. I also recommend looking this up because it gets pretty complicated and even I don't fully understand complexities of this. Look up cost segregation analysis when it comes to rental property, especially if you've just done a big renovation or anything like that. Look into it. It could very well save you a ton of money just by looking into it and using cost segregation analysis. However, just keep in mind that because you're depreciating the value of the property over so many years, it lowers your tax basis on the property. Meaning that if you bought, let's say, a $100,000 home and you depreciated it $50,000, so now your new tax basis is $50,000, but now the home is worth $150,000. Instead of just owing tax on the $100,000 that you bought it at to the $150,000 that it's worth now, because you depreciated it, your new tax basis is $50,000. It's now worth $150,000. So if you sold it, you're going to pay tax between the difference of your tax basis on the property and the new price that you sold it for. However, one of the great ways around this, and this is now my number 4 point, is the 1031 exchange. So a 1031 exchange means that you can sell an investment property and exchange it for a like property of similar or greater value. When you're doing this, you're not paying taxes on any profits, and instead, you're just deferring the taxes, putting it into the new property. So as an example here, let's say you bought a property for $200,000 and then you depreciated it $100,000 over 10 years. So your new tax basis on the property is $100,000. But let's just say now the house is worth $500,000. Keep in mind that's a $400,000 gain that you would have to pay taxes on between the amount that you depreciated and the new value of the property. This would equate to a pretty significant amount of taxes. But if you were to 1031 exchange that, you can sell it for the full $500,000, not pay any tax on that, and basically move your tax obligation to the new property with a new tax basis. By doing this, you're able to continually just defer the taxes you would owe, and you can continue doing one 1031 exchange after another, after another, after another, basically just using the taxes that you would have paid towards the new property. And you'll also pay taxes on your gains whenever you sell the property without 1031 exchanging it. So just keep this in mind that if you 1031 exchange for like decades and then all of a sudden 30 years down the line you decide to sell that property, chances are you're going to have a pretty big tax bill because you've been depreciating the property over so many years The value's gone up over so many years, and the difference between your tax basis and the new value of the property is probably going to be pretty significant. But what most people end up doing is they just continually 1031 exchange one after another, just increasing the rent that they get. And this is how so many people can accumulate millions of dollars in real estate without ever paying capital gains taxes on their investment. And keep in mind, by the way, this doesn't really apply to flips if you're just going and flipping properties. Typically, a 1031 exchange is for investment properties that are used as rentals. Now, on the subject of capital gains, consider this. As a primary residence, if you've lived in the home 2 of the last 5 years, you can sell the property for $250,000 higher than your tax basis is, or higher than you bought it for, without owing a dime in taxes. This amount grows to $500,000 if you're married. This means that you can buy a $500,000 home, sell it 2 years later for $750,000 and walk away without really owing any taxes on it. If you're married, you could sell that $500,000 home for $1 million. Now, obviously, I'm simplifying things a lot here, but just to give you an example, this is a huge advantage of owning a primary residence long term. And if you sell that property any higher than the $250,000 if you're single, or $500,000 if you're married, it counts as long-term capital gains, which is taxed a lot lower than earned income. And keep in mind, the long-term capital gains rate is at a pretty low rate, all things considered. So the next one that I mentioned in one of my previous videos is about the cash out refinance. This is where you can pretty much borrow against the extra equity in your home, pulling it out completely tax-free, and then using that as a write-off against your rental income. Now, even though this is technically a loan and you do have to pay it back, you're only loaning against money you already have in the property. And by doing this, you're able to reinvest the proceeds and get an even larger return. Now, this gets a little bit more complicated when it comes to pulling out equity and refinancing a primary residence. I believe it's the first $100,000 can be used as a write-off for basically anything you want, and anything over that is not deductible unless you spend it back on your property. But again, you'll have to look into this. They're changing all the real estate tax laws and all this sort of stuff, so I'm still looking into this. So we'll see what this is going to be like when that passes for 2018. But overall, for a rental property, all the amount that you pull off is just a deduction against your rental income, and it's all used tax-free. Now, number 7, when it comes to getting rental income, it's not taxed as self-employment income, where you would have to pay FICA and self-employment tax. This means you could immediately save 15.3% by not paying self-employment tax. Ask me how I know, because I have to pay that as a real estate agent. And trust me, when you pay this, especially if you're ever 1099, it puts a huge dent in things. Now, holding real estate, though, does not include this. Now, keep in mind, it also depends how you structure your business. If you're holding real estate, by the way, in like a C Corp or something like that, you may end up needing to pay the taxes, so definitely talk with a tax consultant about this and how you're holding real estate, because that will affect it. But generally speaking, if you're holding it in your name, or maybe an LLC or something that's not structured, too differently, you're not going to pay that self-employment tax. Now, before I wrap this up, because I'm not a tax consultant by any means, this video is just meant to be an entry-level introduction to some of the tax write-offs available in real estate. Please check with your CPA or accountant first, because when it comes to taxes, a lot of this is so specific to the individual and whatever their unique situation is. So it's not always that one plan will fit 100% of the people. These are some of the tax write-ups that I have used myself that work for me. But again, what works for me might not always work for you or make the best sense in your situation. So like I said, please, before applying any of this, check with your own CPA or accountant to make sure this is best for you. So as always, you guys, I hope you enjoyed this. Thank you so much for watching. If you haven't subscribed already, make sure to smash that subscribe button and also smash that notification bell really hard. Just keep smashing that button so YouTube sometimes notifies you when I post a video. They have been great about notifications lately. Thank you, YouTube. Win for the Graham Stephan channel. So make sure to smash the subscribe button, smash the notification bell, and if you haven't added me already on Snapchat or Instagram, feel free to follow me there, because I post there pretty much daily, a lot of stuff behind the scenes and what I'm doing throughout the day. So if you care at all, feel free to add me there. And then also feel free to comment down below. I've been great, by the way, about responding to, I would say, the majority of comments. So if you want to say anything, any video requests that you would like, or any topics that you would like to see more of or want me to go into more detail of, let me know down below. Like I said, I read every single comment, and I'm more than willing to take anything into consideration and make videos tailored around what you guys really want to see the most. Thanks again, and until next time.